We think single digits in the end, which will mean silver will be even higher than our target at 333, our localized high target. We see single digits. At the moment, you're still in that phase where you've had a reversal against a very steep move to the downside. It's natural that that happens. You're right about getting into the 40s on the low. We went as low as 43 gold silver ratio, and now you're sitting at 64, which is quite some rally. As I say, there's probably a third impulse still to happen, which means you might be, but the third impulse is always the smallest and takes the least time. The gold's second sell was even larger by amounts. This was $1,300. You went from over 5.4 to below, right down to the 4,098 here. So that was a bigger sell than the initial one. So gold was more rattled the second time, but it has also reclimbed a lot further. It's had a little shooting star.
The gold to silver ratio is currently navigating a natural reversal phase after a sharp move to the downside, with the ratio sitting at 64 after previously dipping into the 40s. Despite recent volatility, the technical structure points toward a third impulse that could drive the ratio into single digits, signaling massive outperformance for silver. Francishunt, widely known as the market sniper, is a world-class technical analyst and trader who specializes in identifying high-probability breakout patterns and macro trend shifts. With decades of experience in the hunt for asymmetric trade opportunities, he highlights that while gold was significantly rattled during its second sell-off, dropping $1,300 from its highs to a floor near $4,098, it has since reclaimed substantial ground. Hunt's data suggests that although the second correction was larger than the initial one, the rapid reclimb indicates strong underlying demand. As the market prepares for a potential third impulse, the technical objective for silver remains a localized target of $333, with the ultimate macro goal of a single-digit ratio, fundamentally redefining the relationship between the two monetary metals. Now we present the clips from Francishunt's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The real engine is what gold does next as the king of the market. And gold is in a continuation pattern as well, but it's not a falling wedge. It's more slightly broadening structure like this. And again, you've had a big sell. The gold's second sell was even larger by amounts. This was $1,300. You went from over 5.4 to below, right down to the 4,098 here. So that was a bigger sell than the initial one. So gold was more rattled the second time, but it has also reclimbed a lot further. It's had a little shooting star. That's what this candle is called at our splitter, but it's done the perfect way of negating that. It traded down and now has gone and done a hammer all the way back. So it kind of neutralized that. We're already halfway. The problem with this is gold only confirms when it breaks this level, the capping, descending grind line up top here. That's quite a bit further away. You could have to sit out and watch it go quite a bit higher before that happens. And then there's often a return move. So you could buy in, get moved up, and then still get a move that takes you back down. You don't know if that return move will occur before it continues to the upside. But these are all big continuations. There was another time we had a broadening, and we were on your channel, and we discussed this. People will forget it, but I'll just remind them when that occurred. And it was a much bigger one by time. And it was flat across the top, unlike this one, which has a downward descent, but it was a broadening structure nonetheless. And it was also a descending splitter. That's that middle line on a bull pole. So that was your pole. So we called for upside break. And you may recall we called for the 3,000 level to be run when you were at 2,000 on this tiny little fractal squeeze that was sitting on the 2,000 level, because that flat top saw each wick just beat the 2,000 level. We talk about key levels just run. That runs you through to 2K. And then you had this little squeeze up, and that set you on a journey that sees you sitting and trading 5,600 at one point, all the way up from 2,000. So that was a $3,600 move that came out of that. Listen, we went sideways for long enough. It was 2020, before 2021. So we went sideways for 2021, 2022, a large part of 23, and then this detonated early 24. So it was 3 years in the making. That took a lot of patience. But when it came big, and it gave $3,600 on top of the 2,000. So that's a broadening structure. Now, this one is not nearly as lengthy. So it will end sooner. This is where we are on silver. And let's just get rid of a couple of things. A nice clean draw for you. That's a falling wedge. And we have 3 impulses. There is a possibility, it could happen, that you're going to have one more sell-off. So essentially the structure looks like that. And you're going up. You could sell off one more time to the downside. It's not entirely clear that that has to happen. You might have made your 3rd impulse. We talk about 3 impulses in falling wedge. So you might have had it already there, but it might go a little bit bigger one more time. So you could up and over one more time. But if you break this red line that I've drawn, which I'll just double up now, that is the capping, descending grind line that is part and parcel of a rising wedge. You've got an interaction there, and now here. That's this level breaks, it's all moves to the upside. So the minute you see this going here, or if it continued just to march out and break here, you're going to see a lot more from silver to the high side. I don't think it will be easy for it to get into the 50s, and if it did, it would be the 58s to the 59s type range. So the interesting point I will make is silver took its worst hit in the first hit, and it was far more, you can see the gradient has flattened there, and also the amount. You're at 121, and then you went 64. So, you know, it's almost $60 minus 3. That's $57 that you dropped there. From here, you drop from 96 to 61. So that's 34. So you've gone from 57 in the sell-off from the localized high to around 35. It's 35, actually, a little bit more than 34. There's a couple of cents in there. So that's the 35. And each time you've rallied, now the question is, will you have one more leg down here and get into the upper 50s? That would be a wow, invest all you have moment as far as I'm concerned. There's another smaller version of a falling wedge. And as I highlight, these are typically continuation patterns in upsides. You can see the 3 little impulses, very small final impulse in the end, but you can see how well it moved. There's a little upside HVF. These are all continuation patterns all the way up. This is a macro continuation pattern, and you could find that silver spits up to the 109s and 10s in quite short succession once this breaks. But beware, you might get one more down leg. You could break from here. The market will determine, and it may hang off gold a little bit, because the one thing I sometimes say is silver's kind of like the trailer with a bungee cord on the back of the 4x4. We think single digits in the end, which will mean silver will be even higher than our target at 333, our localized high target. We see single digits. At the moment, you're still in that phase where you've had a reversal against a very steep move to the downside. It's natural that that happens. You're right about getting into the 40s on the low. We went as low as 43 gold silver ratio, and now you're sitting at 64, which is quite some rally. As I say, there's probably a 3rd impulse still to happen, which means you might be, but the 3rd impulse is always the smallest and takes the least time. So, you know, the question is, okay, we've had a counter trend move here, and you've got this, you know, you've got what's going on here. What's going to come out of this? You'll either do that and you'll break down, or if we're unlucky and we have a major tech rout and we get into a serious, what I typically call the full financial puke, that would be credit, banks, or, Lehman Brothers type vibes, and tech, AI, deflation, all of those things, then actually you could go up on the gold-silver ratio.
Gold is currently carving out a significant broadening structure, a technical continuation pattern that historically precedes explosive moves to the upside. While the second major sell-off was more intense, dropping $1,300 to a localized floor of $4,098, the subsequent recovery has neutralized bearish shooting star candles with strong hammer reversals. This resilience mirrors the three-year consolidation between 2021 and 2023 that ultimately triggered a $3,600 rally. For gold to confirm its next leg, it must breach the capping descending grind line, signaling a definitive end to the corrective phase and a resumption of the primary bull trend. Silver is simultaneously forming a falling wedge, typically characterized by 3 downward impulses before a breakout. The gradient of silver's decline has flattened, with the most recent sell-off totaling $35 compared to the initial $57 drop, indicating that selling pressure is exhausting. While a final leg down into the upper $50s remains a possibility, representing a premier all-in accumulation window, a break above the red capping line will likely send silver toward the $110 level in short succession. As the gold-to-silver ratio prepares for a long-term shift towards single digits, silver acts as the high beta trailer to gold's move, targeting a localized high of $333 once the financial puke of the broader market settles. Let's get back to the interview.
When you're talking about those commodities, you're actually talking about how far does the dollar debasement go, really.
Yes.
It's just the other side of the same thing. And are there any, in terms of the rebasement, which you're calling a reset, the rebasement to unit of account, that are going to rebase higher and better than any others that you would choose to be more exposed to, is typically the trader or the investor's question. And we've shown that gold and silver prospects exceed copper. Gold and silver and platinum's prospects exceed tungsten, and most listed physical metals that are of an industrial nature, which is not to say copper price isn't going to go up, because in the debasement of the dollar, everything's going to go up. Even things that are going down in real terms are going to go nominally up, but that doesn't mean they'll make good investments. So our favorite way of assessing that is always take the gold ounce as unit of account and divide that said chart by gold ounces. If we just take the example you just asked, which was copper, and I go high grade copper in here, and I go to the futures markets, I'll come back to share the screen. Let's do that and go back. And if I divide that by gold ounces, so the key thing is you need to make your new unit of an account the gold ounce. This is the copper market. It looks very bullish to many if you're watching that. And to some degree it is. You can see it going up. But the real problem you have is that that's in dollars, which has been debasing immensely. Dollars lost to the euro, a failing currency, 12.5% last year. They lost 40%, 42% in fact, to the ruble, and 15% to the Czech krona and the Hungarian forint. So it's not a very stable unit of account anymore, the dollar. People need to realize the dollar is the story now. Units of account should never be the story. They like the scoreboard guy at a cricket match or a baseball match. They're not the stars that are swinging bats that everybody knows their name. They're just there to do a very utilitarian, normie, no mates, no friends, not known, just do the job so that we keep score, a unit of account, do the accounting. It's not the CEO of the company. The problem is the dollars become part of the story, and it's a drama queen, and it keeps falling in a heap and weeping, and you've got a problem. So that's where we are. If you divide copper in gold ounces, you can see why I continue to say that the gold ounce is more valuable, and you're in a declining relative valuation. Despite gold's massive price relative to copper, despite gold's recent sell-off, despite everything, this is a technical chart of relative loss in value. And even to oil, which has recently had an escalation against gold, I expect gold to win. So a lot of people go, oh, now your story of gold beating oil doesn't look so strong. No, it's done everything it should have done. And now it's getting a slap in the face because we have an energy-based attack vector. But this quickly turns into a private credit and financial and bank contagion, because that is the true drama. The Strait of Hormuz is just the ruse. It's just the ruse. It's an engineered outcome where they use energy. So energy markets are regularly utilized to bring in either deflation, inflation, or stagflation, because it has a multiplier effect and it hits all consumers broadly, universally. It affects travel, especially if you like to reduce people's freedom of movement. It's a very, very useful tool. It's more than a commodity. It's a financial weapon. It's a military grade weapon that the hidden hands love to utilize. It's a fire starter. It's an economic arsonist for bringing in debasement economic policies. So here's an example. Gold wins. Gold is winning. You compare to where it was in 2007, and that was how many ounces you need. Now of gold you could buy with an ounce of copper. Now you're 1/6 of that. So you've lost 5/6. It's the same as having, 80% deducted from your salary. It's just an underperformance. So people are going to get excited about copper wrongly because they're looking at nominal terms. And that's going to apply on all commodities. The best commodity for a monetary-based debasement of fiat and debt is a monetary metal. When do you pick up a fire extinguisher if you want to loosen a bolt? You get the shifting spanner, to loosen the bolt. You don't pick up the fire extinguisher. And if it's a fire, you don't run at it with the shifting spanner. The tool for the purpose, precious metals, is the monetary preservational asset in a period where the derivative proxy is failing. Take the shifting spanner to the bolt, take the fire extinguisher to the fire. Use the tool for its best. Don't say, fire extinguishers are doing well when you've got to tighten a nut or loosen one. It's the wrong thing. Yes, they'll do okay generally, but they're not made for purpose. The tool that is specific to purpose is this, but everybody wants to sprawl into other things. You only have to be in the right one for the times you're in. The right one for the times you're in is capital preservation, physically held monetary metal in a derivative proxy that is in the ether in electronic digits held on some computer and database that you have no control over, for which lockdowns and restricted withdrawals and all forms of things can be brought down on you whilst they debase the derivative proxy and socialize the losses, which is their game that they have played repeatedly and is their multi-generational power, the right to issue money and control your access to it. That is how they've maintained the power. Gold actually is yours in your hand. You hold it. No one can come and stop me from picking up my ounce of gold. They have to come to my house with a gun. They have to come to my vault with a gun. They have to know where it is. They have to go, it's not plausible. Possession is 9/10 of the law. Have the tool for the times. It's capital preservation times.
In an era of rapid dollar debasement, nominal price increases in commodities like copper can be deeply misleading. While industrial metals may rise in dollar terms, they are often collapsing when measured against a stable unit of account, the gold ounce. For example, copper has lost 5/6 of its value relative to gold since 2007, demonstrating that it is a poor tool for wealth preservation. Investors must distinguish between assets that move nominally higher due to currency decay and those that provide true capital preservation. Precious metals are the specific tools designed for monetary fires. The current volatility in energy markets is often a ruse, masking a deeper contagion within private credit and the banking sector. While energy is frequently utilized as a financial weapon to trigger inflation or stagflation, physical monetary metals remain the only assets that take the power of issuance and withdrawal out of the hands of the hidden elite. Holding physical gold ensures that your wealth is not merely an electronic digit subject to lockdowns or restricted access. As the derivative-based financial system continues to fracture, the shift toward physical possession becomes the only logical strategy for multi-generational power and self-reliance. True wealth is not found in the scoreboard of a failing currency, but in the sovereign possession of the metal in your hand. Share your thoughts in comment section below. If you found this market analysis valuable, please support the channel by liking this video and subscribing for more exclusive precious metals content. Thanks for watching.